I asked Brian Shepler to be here with me today because I'm going to provide a little bit of a theoretical overview, and then Brian's going to delve a little bit more into the technical components of what we're talking about. We're talking about tokenization of real estate. Brian is a successful entrepreneur, exited a very large technology company and has now set his sights on the real estate industry. He's always been a real estate investor, but now creating a company in the space. So he'll tell you a little bit more about that. So I want to start out with what is blockchain. And you probably thought, man, he put the wrong slide. There's no way that this is the right slide. I'm talking about this cutting edge technology. But it is, in fact, the right slide. We got to go back 500 years to the development of double entry accounting. Just a ledger. We've used ledgers for 500 years since this guy, Luca Pacioli, a Franciscan friar, developed the technology, right, during the Renaissance era so that the Medici traders could trade over time and space without having to trust their counterparty. And it's worked relatively well, right? It's facilitated a lot of business and a lot of commerce for centuries. So that brings us to 2008 when the Bitcoin white paper was published as an academic paper, described how you could create a distributed consensus mechanism for solving property rights in the digital space, right? So in its most boiled down form, a blockchain is just a distributed, decentralized ledger. They can be public or private. Public ledgers like Bitcoin, Ethereum, private ledgers like IBM's Hyperledger or some of the other, what you would kind of know them as permissioned blockchains. And the word block just comes from a block of transactions that are chained through a immutable link by hashing the previous block's transactions to the next block. That was way oversimplified. Brian's going to get a little bit more into the technical pieces there. I'm going to skip this slide about Bitcoin mining. Suffice it to say, all public blockchains have a consensus mechanism. For Bitcoin and others, it's proof of work. For some of the others, Ethereum just transitioned to proof of stake yesterday, ironically. For 10 years, it's been proof of work, but they transitioned yesterday to proof of stake. It's been a year-long process, just so happens it was yesterday. Proof of stake is another consensus mechanism. So here's the real business problem that we're solving here, right? Digital scarcity. Verifiable chain of title. So it doesn't have to be real estate title, it can be ownership of anything. Ownership of an asset, money, digital assets, real estate, whatever. So what we saw with Napster was they pretty quickly broke the record industry's business model by creating infinite numbers of downloadable music. There was no way to keep that scarce. When you have a Word document, you can send it to 5 people, 100 people. You have no really way of tracking, the original. How do you keep from inflating it? That's why digital currencies have failed in the past. There've been attempts at digital currencies for decades. Probably, I'm sure the CIA was working on it in the 60s. But there was no way to really prove digital scarcity because anytime you get something online, one of the things about the internet is it just creates this infinite replicability and inflation. And when we know about assets like real estate and other assets like gold and money and currency, is you really don't want uncontrollable inflation. You really don't want any inflation, but that's a debate for another day about what the optimal rate of inflation is for the US dollar, say. But with real estate, it's impossible to get inflation because it's a physical asset. In the digital world, not so much. So that's what we're solving with blockchains. There's something called a blockchain trilemma. Not going to spend any time on it. You can look it up if you want to. Just know that blockchains really can't solve all 3. They can optimize for 2 of the 3, and then they're maybe a little bit weaker on the 3rd. So for example, Bitcoin optimizes for security and decentralization. With Ethereum's recent merge, they've sort of switched to optimize for a little bit more scalability, and then given up a little bit of their security. Okay, how does real estate tokenization work, and what does it really mean for the industry? Again, I'm going to do high-level theoretical, and then Brian's going to get a little bit more technical. A token is just a digital representation of an asset, of ownership of an asset, to be more precise. So look at this token like a stock or a share, right? In public markets, if it is Compass publicly traded, or is it privately owned? So Compass shares are trading on NASDAQ or wherever, and it's got pretty good liquidity from Monday through Friday, 8:30 till whenever the trading day ends, like 3:30 or 4:30 or something like that. That's a decent liquidity. Real estate for millennia has had very bad liquidity. Does anybody, raise your hand if you could tell me the real estate jargon term for what that bad liquidity in the real estate industry? So it's not a blockchain related term at all. It's the illiquidity discount. So the illiquidity discount. You are able to sell a home for less because there's not an active market for like shares in that home, right? You've got to find a buyer that has an interest, that has cash, so some real estate experts estimate that the illiquidity discount for real property is up to 20% in some markets. So if you could trade real estate like you could trade the stocks, you could see 20% higher prices because you have more eyeballs and more buyers that can look at that asset. And it's not encumbered by a 30-day closing process. So imagine if you could take the public market liquidity that you have in the stock market and bring it to the real estate industry. Primarily, we're going to be talking about the commercial real estate industry today. It's applicable to the residential market as well, just less of a sea change. It's more incremental advantages, so we probably won't see it in residential for some time. So I'm going to hit one policy thing and then hand off the mic. The Texas Blockchain Council helped to research and write two pieces of legislation that passed in the last session, in the 87th session in Texas. One of those was defining what virtual currencies are, defining how you perfect your security interest in that, which I won't bore you with all that legalese, and defining how you control these digital assets. Like, y'all will be very familiar with probably liens and UCC1 claims and things like that on property. In the digital world, it's a little bit more difficult to ascertain, does someone have a lien on this digital token that represents ownership on that property, right? So what we did is we clarified all that, and you can perfect your security interest in assets as collateral, like say Bitcoin as collateral, simply through the possession of the cryptographic keys. You really don't have to know what that means to be able to do business with that information, right? I send emails every day, but I don't really know what TCP/IP protocols do. I just know that they're called protocols, and that's how email works, right? So blockchain is very similar. You don't necessarily have to know how it works to be able to take advantage of the business use cases that it could afford, people in the real estate industry. I just said all that, right? This is what that one law did, it still does it. And I'm gonna sit down for a minute, turn it over to Brian. I think we are gonna do some question and answer in a moment. But Brian's really gonna dig into, in addition to the illiquidity discount, what else is this doing for you, right? It's also fractionalizing. It's also, increasing the number of investors that could potentially look at a project. So you're not having to syndicate, with where the LPs have the negotiating power. Maybe you as the GP or the realtor have a little bit more power. Not that GP and realtor are synonymous, but sometimes you kind of find yourself on the same side of the bargaining table. So you have a little bit more power and control. With that, Brian Shepler.
All right. Thank you, Lee. Can you hear me all right? Okay. This was already mentioned, so I'll just skip over that real quick. Disclaimer, you might hear me talk about some some issues regarding law or crypto, which may be considered investing. Please don't take that as any advice on investing in anything that you hear. You should all be doing your own research along those lines. Okay, so what I'm going to talk about today is build upon what Lee already mentioned with tokenization. Talk about securities at a very high level, give you a little bit of information there. Dive into blockchain technology just a little bit. Cryptocurrency, stable coins, wallets, these are all terms you might have heard. We'll touch on some of that. And then the very interesting pieces that we'll talk about that you should take away are things called smart contracts. And we'll dive into that. And finally talk about tokenization of commercial real estate, which is where this really has great benefits today. Okay, so securities. Security is nothing more than a negotiable financial instrument, represents some type of financial pretty broad definition. It's basically anything that you believe you'll be making money with or your expectations of making money. Security tokenization is the process of taking those assets, those wide-ranging assets. It doesn't have to be real estate, it could be companies, it could be some physical asset, art, for instance, and it divides that asset into digital shares, just like shares of Compass that are traded on the stock exchange. And they are represented with digital tokens. The digital tokens are created and they exist on the blockchain. And we'll get into blockchain in a little bit as far as what that is. And they do represent ownership of the underlying asset. So they can be customized, programmed, traded, and collateralized. That's a pretty big statement there. You can use these digital tokens as collateral for loans, for instance, if you find a third party that is willing to do that. And finally, assets can be tokenized without having to be designated security. Okay, we'll go over this real quick. Securities, specifically with real estate. Does everybody know the term syndications? In commercial real estate, it's just where many people get together, pool their money, invest in an asset. And that is a security. That's one definition of security, and that's what we'll be talking about through the remainder of the presentation. The SEC is very much involved in the securities, and there are exemptions that you can qualify for, so you don't have to register with the SEC like you do when you issue stock. And that's how most syndications will actually sell their shares. The laws and the rules that are there for the SEC, from the SEC, are there to protect the investor, not from bad investments or from losing money, but from fraud. And the existing legal framework that's in place from the SEC, that applies to all securities. The tokenization does not circumvent this. It just adds a layer on top of how it treats the shares of that asset. Okay, blockchain basics. It's a technology first proposed in 1991. It basically is a distributed shared database. Very simple. It's transparent and it's decentralized. What that means is there's not one computer running any one place that is the database. The database is shared amongst many hundreds or thousands of computers running in many different locations all around the world. They all have their own copy of the database. And when changes are made to this database through the blockchain by adding blocks, you might have heard Lee mention that they put the new blocks point to the old blocks, and that's how the chaining is accomplished. When new blocks are added, a majority of the computers that are running have to agree and come to consensus that it is a valid block and it should be added to the blockchain. So that you've heard the word consensus as well. The data is immutable. That means once it's added in a block, it does not get changed. There's no editing, there's no changing, no deleting. It's there forever. You can go look at the Bitcoin blockchain from day one. You can search it from block, the Genesis block, onward to the most recent block. You can look at it. You can see every bit, every character that's in there. There's nothing missing. Any type of data can be stored. This is most commonly used with ledger type transactions like cryptocurrencies, but there's no limitation. You can actually put images in a blockchain. You could put structured data. It doesn't matter. Whatever you want to put in there, you can. And cryptography is used to secure the data. That's where we get the immutability is from the cryptography. Okay, this is a visual representation of blockchain. You can see block 1, block 2, block 3, and there's data in the blocks, and there's something called a hash. A hash is a signature of all the data in the block. If that data ever gets changed, the same algorithm that's used to create that signature will change. So that you might be very familiar with signing a document, digitally signing a document, right? Well, you get these little codes around the signature. Well, what they're doing is they're taking that document and signing it with a key, and if anything ever changes, it's going to be a different signature. So that's how you know that that hasn't changed. Same type of technology is used here. So as a new block is added, it gets added visually, it gets added to the right, and effectively points back to the prior block. Okay. So we've all heard about Bitcoin and maybe a few others, but I'm going to talk about stablecoin. Stablecoins are a type of cryptocurrency which is needed for, in my opinion, for purchasing and for exchanging your coin for assets. This type of cryptocurrency is designed to have a stable price. So 8-9 months ago, Bitcoin was at 69,000. It's at 20,000. You don't want to use that type of currency to purchase real world items. Between the time you agree to purchase and you bring your money, it might be a completely different amount of dollars that you pay. So the purpose of crypto stablecoins is to provide that stability in the form of a digital exchange of value. There's two types. One is completely backed by hard assets, whether that would be gold or the US dollar. The other is an algorithmic stablecoin. So I would much rather prefer, if I have a stablecoin, that it's backed by a dollar. And the way that that works is the issuer of the stablecoin, when they get a purchase of that coin, let's say $100, they actually put that money in a real bank account in US dollars, and it's there. So if there's $1 billion of stablecoin in circulation, there's $1 billion in a bank account somewhere. So there's a one-to-one correspondence. Now, if everybody wants to sell their stablecoin all at one time, redeem it, there's money there to do that. Okay, so this looks a little bit choppy, but this is USDC, which is US dollar coin. And this is a stable coin that's backed by the US dollar. The company that provides this, like I said, just puts $1 in the bank account every time they get a request for the purchase of their coin. And this looks pretty volatile, but if you look at, this is $1, and that's 0.02 of $1 right there. So it is very stable. That compared to many of the other cryptocurrencies. This is a type of cryptocurrency that you would use to purchase real estate. smart contracts. So this was probably the aha moment that I had when I first started looking into blockchain. And when I first started looking into crypto, I just was looking at the coins. Once I saw smart contracts and saw what they had to offer, that's where I saw how the financial institutions are going to be flipped on their head. And processes that we use today to do business, to transact, will be changed quite dramatically. And it's already starting to happen. So what is a smart contract? This is nothing more than a self-executing digital agreement between two parties. It could have more than two parties, in fact. It is, in fact, a program. The program lives in the blockchain and is executing by these large number of computers that are out there securing the blockchain. So those hundreds or thousands of computers that I mentioned previously, they will actually run the smart contracts. They run the programs that are the smart contracts. These smart contracts define rules, requirements, and penalties of agreements. Think about your contracts that we use today to transact. These smart contracts do the same thing, but in the digital world. So they will emulate the same actions and will facilitate the transaction and the transfer of money and property between the parties. The code is actually written and saved in the blockchain. Remember back we said it's immutable, that means it can't be changed. So the two parties have complete confidence that the contract they agreed to can't be changed. So percentages or purchase amount or whatever that might be, it's in the blockchain. Everybody can go see it, and they have confidence that the code, the contract, will not change without the introduction of a third party. Right? This is they call it a trustless environment. I don't like that word. I like to think of this as a trusted environment that's running all these programs. So you've heard, we talked about Ethereum. That is a cryptocurrency, but it's also an environment. And it's an environment that runs these smart contracts. Everything that happens in crypto has to happen in smart contracts. Okay. So this is just an example of the blockchain, just to emphasize that smart contracts, the definition of the smart contracts are actually held in the blockchain, and the data is also in the blockchain. So remember back we said everything was viewable, transparent. You can go look at any of the prior data and any of the new data that might be written in the future. Okay, so smart contracts. This is very high level, but I'll kind of go over this. So today you're connecting a buyer and a seller through a transaction. You've got a lot of things that are happening in the middle. Lawyers, brokers, insurance, all these things. You got escrow, you got all these parties that have to be trusted so that buyer and seller can transact in a safe way. So that's what the smart contract will replace and does replace.
Us? It'll replace us?
No. It facilitates the work that you do, right? That's what don't think that the technology is there to allow you to do more. There's rarely cases in technology that people are replaced. People need to adapt for sure, but what it usually does is it automates processes and it makes you able to do more, allows you to do more efficiently with less errors. And that's what this does as well.
Can I throw a point in there? It could potentially disrupt elements around the real estate industry like title and other things. But as Brian's saying, not going to get rid of title. It's going to increase market share for companies that adopt. Just like if you were a retailer and you were, in the 90s, you were slow to get online, the retailers that got online sooner increased their market share quite a bit. So the title companies that get on board and start utilizing this technology, could potentially increase their market share relative to the others. Maybe not so much in Texas because we have a heavily regulated title industry, but certainly in other jurisdictions.
And
But I don't, and for realtors, I don't see
no,
big
and
disruption.
on the retail side, this doesn't have as much benefit as it does on the commercial side. And I'll get into some examples in the next few slides as far as how that comes to play there. So I guess my main point is smart contracts can allow the buyer and the seller to enter into a contract, exchange data, and the smart contract holds that data or holds the title or whatever, the money, if you will, the escrow, until all the points of the contract are met. Okay. So smart contract examples, we have financial derivatives, insurance premiums, financial services loans, purchase agreements, equity raising and crowdfunding, government, so voting. Imagine if our voting was actually on the blockchain. Everybody could see it. Everybody could count the votes, and there would be no question about stealing. Now, that's a pretty bold statement, but visibility and transparency is always better in that respect. And then security tokens. All right, so commercial real estate is where this has the biggest bang for the buck right now. And that's because the structure of a commercial real estate deal lends itself really nicely to this approach. So we'll take an example of a syndication that occurs. There's the sponsor of the deal will offer shares, not in the real estate, but in the company that owns the real estate. And that's a very important distinction. We're not splitting up the real estate into tokens. What we're doing is we're splitting up the company that owns the real estate into tokens or shares. It's the same way that happens today. We're not creating new legal entities in the US. Those are the same, we're using the same ones that exist today that existed 20 years ago. Once the tokenization is complete, you basically have a digital representation of these shares. So if the sponsor issued 100,000 shares in their deal, and they were worth 1,000 apiece or 100 apiece, whatever it was, you invested in, you've got 100 shares, you now own 100 tokens. It's yours to do with what you want. You can trade them on an exchange because now they're digital. You can trade them with somebody else, which is something you can't do today in a syndication deal. Once you're in a syndication deal, you're pretty much in it until the deal sells. The smart contracts facilitate a lot of the operations of the syndication and of the ongoing operations of the business. And stable coins are used for all the transactions. And that's because we need a stable monetary exchange to be able to invest in this company and also to take out dividends and to get paid when the investment is doing well. The software platforms that are built around these smart contracts, they will implement the know your customer, anti-money laundering, the initial funding, distributions of profits, quarterly dividends, shareholder voting, governance, go down the list there. These all can be implemented by these smart contracts. Again, they're secure, transparent, immutable. So that means they can't be changed. Once you are recognized as a shareholder, you're in the blockchain with how many shares that you purchased. You sell some of those shares, that transaction is in the blockchain. And so it can be all chained together, and the information is there forever. Today, less than 1% of all commercial real estate deals are traded publicly. So there's a huge number of very profitable deals that most of us can't get into. And it'd be nice if some of those deals, like this building, I'm sure this building is owned by some type of syndication. could be a collection of insurance groups, could be a collection of governments, who knows, pension funds. But we can't get in it. It might be very profitable, but we can't invest in it. If it was tokenized, tokens could be traded, and you could come in and say, I want to look at the financials. You see the financials of the building, of the business. It's making money. You want to invest in it. You go find an exchange and purchase a share. Simple as that. Now you would be listed in the blockchain as an owner of that share and of the business that owns the building. You then get all the rights of the share. Okay. So benefits of tokenization, I think the top one is liquidity. So if you're in a syndication, it's very hard to get out. Let's say you put $100,000 in, if you want to put your kid through school, you can't touch that money very easily. If it's tokenized, you could sell some of your shares to pay for college or any other life events that may occur. There's great efficiencies that are offered by these smart contracts and by tokenization. Fractional ownership. I don't think that these apply very, very nicely to the single family residential home, but I have seen a few cases where they are being split up and investors are purchasing single family homes for rent and offering fractional ownership for that. Again, transparency, immutable collateralization, that's a big one. Once you own a share, it's digital. That means that you can use that share and go to a third party and use it as collateral for a loan if you wish. Let's use our example with paying for college or a life event. You might not want to sell your share. You could use it as collateral to get a loan to pay for whatever you wanted to use the money for. That then is a loan that's backed by your share. You still own the share, but because it's digital, it's locked. That's something that can be done. It's programmable, customizable. So this lender could lock that share and you can't sell it, but it's still yours. You still participate in dividends. You still get the benefits of ownership. You just can't sell it because you owe them money. As soon as you pay off the loan, they release the lock. The cap table management is very useful for the sponsors. That is just a fancy way to say who owns all the shares, who are the shareholders. And finally, something that Lee touched on is when you make a private investment public that is open to the public, you open up a whole new pool of potential investors, demand's increasing, and so your valuation will increase. Some estimates go up to 20%. Okay, so this is just a kind of a listing of what we talked about. Again, I think the liquidity and the efficiencies that are realized is the main benefit of tokenization. Again, all this runs on the blockchain, and it's all secured by these hundreds and thousands of computers that are out there running. And that's it.
Do you guys have any questions for us about how this works? And we had a great question about, does this disrupt the, realtor? Does Compass do more than, are y'all also a mortgage banking title? Do y'all do all those other things too, or hopefully run the gamut? Yeah. So I would look like on the disruption side, certainly in the title and mortgage banking side of the industry, there's certainly, you probably want a lot more attention on this than maybe the single family realtor or person like that.
They don't. Our title people were just here. Yeah.
Oh, was it the person that left after I said title could be disrupted?
They weren't ready to answer any questions.
So you mentioned the liquidity, efficiency, and fractional ownership. How does tokenization differ from a traditional REIT? Because that's what a REIT's doing.
Right.
I believe. It's
I'll-
kind of hitting those three.
I'll hit a few and then Brian can talk about a few. So with the traditional REIT, you certainly have friction in changing ownership as far as like legal fees and different things that the REIT is sort of passing on to the investor, whereas this would sort of do it more efficiently. 24/7 market in some cases. It depends on what kind of alternative trading system you're on, but it could be a 24/7 market at some point. So there's some others.
I mean, it takes, you don't see it today, but it takes 2 or 3 days to settle trades.
Yeah.
And the cap table management, that is who owns your shares as a company owner, there's no, at any one point in time, you don't know with 100% certainty who owns the shares. With something like this, you do have it settled within seconds or minutes at the very least. It gives you very good efficiencies in distributions, frictionless. You don't have to worry about.
And the biggest thing is you don't have a REIT taking a cut of the investors' profits.
There's so many third parties along the way that have their hands in this, and there'll be a lot of pushback because anytime you're disrupting a financial industry like this, it's people get scared and they want to maintain their nice cushy jobs, I guess. But change is great. Change pushes us all forward.
In light of that answer, would that also apply to a home equity loan if you were looking to get some of your money for college or whatever? Same goal, but that would be the answer. It's faster and less friction than anything else.
Right.
This is the collateral. You don't have to fill out forms. You don't have to. The lender can look at the token and they can see what the value is in the token. And so it doesn't matter who you are. It doesn't matter how much money you make. You're lending based on that collateral.
Okay.
So it's good. It's fast. There's an industry has popped up and it's called DeFi, decentralized finance, and it's geared around things like this. You might have heard the word staking, where you can stake tokens or stake crypto.
Then how would someone put their home out 25 years before any of this was invented? How would they put a token on it?
So what you would do is you would create a legal entity, a partnership probably, that would have, let's say your home is worth $500,000, it would have 500,000 shares. So each share would be initially worth $1.
Who would do that though?
Any
Brian's
lawyer
company
could do that.
can do that.
Yeah. So
and there's a lot of companies and attorneys that
and you don't need a security token to do that. You can go do that today if you wish. You can create an entity that owns your house. It has that many shares in it, and you're the only shareholder. Well, you could then enter into agreements to sell some of those shares to somebody else. But you have to have operating agreements in the LLC that holds the shares because your investors need to know what the rules are around and what their rights are when they purchase the shares.
And maybe it's just me, and I'm not following, but you've got title to your home, you own your home, but you want to have it tokenized. I missed in here somewhere, does it go through all what you just described, or is there someone that then gets it in the blockchain and it's done?
Yes.
So you can either do an LLC and have to share everything
Yeah.
that we're
You
used to
can do
doing
that.
if you're going to split up ownership like that.
So the
Or you
operating
go to someone and get a token and you have it to do.
The operating agreement will spell out that there'll be security tokens issued one for one
But
with shares.
you owning it 100%, you would just have your own operating agreement.
If that's how you start, yes.
and then you may choose to sell 20% of those tokens to private equity
Or it'd be
investors.
collateral to the bank, as you said, to get your kid to college or whatever.
Yes.
But you may get a better deal if you go to the open market. You're a captive audience with the bank, but you may get a better deal if you say go to.
But you have to sell it.
No,
You
well,
wouldn't.
so it depends on your operating agreement, right? You're the one who's going to define the rules and the guidelines around the shares that you sell. So for instance, what you could do, there's a large number of people who live in different countries who want to own U.S. property because of our strong property rights and consistent history. And what you could do is offer 20% of your tokens for sale at that price. And the only thing that they get is 20% ownership of your house, but they don't get to stay there. They don't get to tell you how to run it. But the only thing they do is they share in when you sell your house, in the profits. That's all that they would be buying. So that's one example of how you could do it and
But
realize it.
that's not a loan, I mean, you're selling it.
That's a,
Yeah.
right, you're selling the shares and you're pocketing that money at that specific time. But if you do tokenize, then you could utilize some of the on-chain DeFi companies and offer your shares as well.
And that wouldn't be a loan, because then you're getting cash or a stable coin which represents cash, but more like cash.
So in that equal comparison, it's just efficiencies that you're gaining if you do tokenization.
Right. So here's an example. There's a hotel in Aspen, Colorado called the St. Regis. Beautiful hotel. A couple years ago, they tokenized a portion of it. They weren't quite ready to tokenize the whole thing. So I think they tokenized was like 20%. 20%. I was gonna say 17%. So it's 20%. I bought a share when they tokenized it because I thought this is cool. They tokenized St. Regis. I think one share of the St. Regis was like $4,000. So I was like, okay, I'll buy one share of this beautiful, iconic hotel. And they didn't change anything about how they ran the hotel. It's just a way for them to, instead of going into the debt markets, they went to the equity markets and got a little bit better of a deal, perhaps, or they had a little bit of appreciation, the value, because they had this global interest, like, oh, this is a crazy, huge, big hotel that's being tokenized. Investors from all around the world pay attention. The supply and demand thing, the more eyeballs you have on it, the more demand there is for that share of ownership, therefore the price went up. So I kind of knew that it wasn't a good investment. I was like, all right, this is sort of all eyes are looking at it. It's going to be inflated. I just want to buy it anyways, just to work out the kinks. You just go to a broker online. It's called an ATS. They're alternative trading systems. They're SEC regulated ways to trade securities. And it's like NASDAQ basically, or like when you log into your Fidelity account, you buy publicly traded stock, you log into your T0 account or your, what's the other big one? T0 and Tokenize, or there's a couple big ATSs. And you just log in like you log into Fidelity and you see the shares and you purchase a share of the asset. Don't ask me if I lost or made money. I don't. I actually don't know. I could pull it up. I would guess that I've lost money.
I think it's about the same.
Is it about the same?
I think you're pretty safe. It went up initially.
Yeah.
I think it's settled about
All that.
But I think, so some of the things, right, that was one of the first public offerings. And so there was a lot of appeal for that. And I don't think they offer dividends through that, right? So the only time you'll actually profit is if the inherent value of the hotel goes up,
right,
which will be reflected in your share price. Or they sell to somebody else, and then you'll get your percentage of the sale.
I feel like I'm killing everybody here, but on the security token, I think you called it, no, the stable coin. I get the stable coin because it's got something behind it. How does that translate over, or does it translate in real estate to other types of cryptocurrencies, or does it have to be a stable coin?
Doesn't have to be.
You can transact, and as long as the parties agree what coin, what crypto to use, you can transact. In today's world, it's almost always going to be converted to a dollar because the usage of crypto is not very widespread yet. I think the stable coin is where it's first going to be used, because when you enter into the contract, your agreement to buy for $100,000, well, in 4 weeks from now when it finally closes, it's going to still, your money that you put in escrow, your crypto is still going to be worth that amount of money. Whereas if you put in Bitcoin, it may have dropped. And so you might have to come up with more Bitcoin. So that's the purpose of stablecoin, is it provides that stable exchange of value in a digital form. So you use it digitally. You can use the blockchain, whatever blockchain that the crypto is running on, and that's where the transactions will occur. It's yes.
I'm piggybacking on that. As opposed to stable currencies, where does the money go that a volatile currency is purchased with? Question mark?
It's just like a stock.
Yeah.
So if there's more people who are trying to sell, whoever owns, there's going to be a bid and ask, so to speak.
Mm-hmm.
Right? So if there's 100 people wanting to sell, only 10 people wanting to buy that coin, well, the price is going to be pressured downwards until it hits a point where more people want to buy and it'll stabilize. That's just the natural progression of price discovery in an asset. Because we transact in US dollars, any crypto that's US dollar based will in effect be stable. Bitcoin is going to be, the price of Bitcoin is going to be dictated by how many people want to buy it versus how many people want to sell it. It's as simple as that. Just because you have Bitcoin in your wallet, your digital wallet, you don't want to sell it, but the price can still go down because it's the other supply and demand that's out there that's causing that price to go up. Just like the housing market.
I would look at the volatile cryptocurrencies, like especially Bitcoin, like digital gold, right? So if I have a 16-ounce gold, that I'm selling, what is gold going? Let's say an ounce, because gold's going for like $1,800 an ounce or so right now. So whenever you purchase that from me, I give you the gold, I have the cash. Likewise, Bitcoin is a scarce asset, like gold is scarce. So if I have a Bitcoin, which is going for $20,000 a coin right now, then you would give me $20,000, I would give you a Bitcoin, and you could then use that however you saw fit. Most likely the same way that you use gold, which is you sit on it, and it appreciates over time, or depreciates. Gold can go up or down depending on the macro market conditions. Does that answer your question?
Any other questions? Thank you so much for all your Thank you. It's a lot of information.
Yeah, that's right. It's a ton. But
It's a ton.
we're both local. We're both in Dallas, so feel free to shoot us an email if you have some more questions.
Thank you so
Thank
much.
you.